Welcome to Careers in Finance. My name is Helena Zenwa, Assistant Dean for Stewart School of Business. We're very happy to have you here today, as well as Rita. And I am going to transition over to our Senior Associate Director, Shazad Hussain, to introduce our speaker.
Thank you, Helen. I'd like to take this opportunity to once again welcome and thank Rita Fiumara for joining us for this wonderful presentation today. Rita, you've been a great friend of Stewart School of Business and an alumni of Stewart School. So thank you once again for being here with us today. With that said, I would like to briefly introduce Rita. Rita Fiumara is the Senior Vice President Wealth Management, and a senior retirement plan consultant. Since 1996, Rita has been helping empower retirement plan sponsors with insight and best practices to meet their fiduciary responsibilities. In addition to her nearly 20 years of experience in retirement plan consulting, Rita's education and professional achievements enhance her capabilities and her consultative process. She has a certified investment management analyst accreditation and a chartered retirement plan specialist accreditation. She is also an accredited investment fiduciary. She has a BA with a concentration in finance from the University of South Florida and a master's in business administration from the Stewart School of Business at the Illinois Institute of Technology in Chicago. With those few words, I now welcome Rita for the presentation.
Thank you, Shazad. What a pleasure it is to be with you this afternoon. I've never been as excited as I am today, and I hope you find the enthusiasm resonating with you by the end of this presentation. I'd like to start off by congratulating the team of finance students at Stewart School of Business who have advanced to the semifinalists at the annual McGill International Portfolio Challenge. Congratulations and the best of luck. We know that you'll always be finalists to us. So what a great representation. So it's an exciting time, really, to be on the cusp of the graduating class at the Stewart School of Business, and such an elite school at that of student body and alumni across the nation and across the world. I've never been this excited, as I mentioned, really because of the developments globally that are occurring in all sectors of the world and all different types of industries of the world. And in fact, right now, we're embracing the highest growth mode that we've ever seen, or probably will ever see in our generation, as a result of fintech, health tech, the digitalization that we're seeing in both of those particular areas, green tech, which I'll talk to you about, and 5G. So this is such a welcome surprise, because I will tell you, back in the beginning of 2020, where we thought that there was going to be much more inequality and indebtedness across all the world nations, with lower yielding returns across equities. Gosh, what a pleasant surprise, and just a magnificent, just catalyst in, the as a result of the pandemic, but really leading up to the favorable market environment and global environment that we're currently experiencing and will be experiencing within the next decade. So with that, I'd love to turn your attention to a couple of the questions that I have that will be really the genesis of our conversation this afternoon. And again, I do want to make this a conversation for us. So I'm happy to take questions. And again, I'd love to have your commentary and feedback as well. But what I'll be addressing this afternoon in particular are the following. Will inflation call time on the bull market? Who will be the winners from this net zero carbon as we see the world leaders coming together to really confront the environment? Can the dollar's rise continue? Has China turned the corner? We've seen some of the setbacks in the equity markets, and we'll definitely bring you, at least from our perspective at UBS, how we see China going forward and some of the positive turnaround just evolving within the last couple of months alone. Should the Eurozone equities continue to outperform? Can I add yield to my portfolio, especially in this very challenging interest rate environment, as really the world globally gets set to perhaps confront inflation through higher interest rates going forward? How can I invest in long-term themes? Why should the equity rally continue? How can I capture opportunities in healthcare? Now, this is such a dynamic area. I could probably do a presentation on healthcare alone. And of course, we couldn't go by with one day without the mention of crypto. So is there more to crypto than speculation? So we definitely want to address that. So without further ado, I'll get started on those questions, but I wanted to make sure, as it relates to our footprint globally and our presence that we have around the world, who we are. UBS is not only one of the largest global asset managers in the world, but of course, we have our Swiss bank, and then of course all the different areas that are really top tier, not only here in the U.S., but as you can see with our main corporate office being in Zurich. I'm really proud to be part of the Wealth Management of America, specifically the UBS Institutional Retirement Consulting Group, where now I've resided. It'll be 25 years. I know I was just a tyke when I started, but hard to believe, 25 years on December 8th, where I have been with UBS, and very proud to be part of really the employee team and group and celebrating just our success over the years. Our strength really comes from our philanthropic services. Again, I can't stress enough why this is so important. We've actually have what we call our UBS Optimus Foundation, and we're number one ranking globally in the world. And this really means a lot, especially for those charitable organization that means so much to us. For every dollar that we as employees contribute, or you as investors and clients contribute, UBS makes a dollar for dollar match for any one of the causes or charitable organizations, not only in the US, but globally. So I'm very, very proud of that. As it relates to our team and who we are with our employees, as you'll see here on the next page, our students and graduates really are the future of UBS. UBS University is one place to grow. You'll see that, not only does our university offer such a well-rounded program, but 2,700 employees that started as students in our Career Development Center that have rotated through the various areas and departments have remained full-time employees with us. And we're very proud of this Career Development Center and the intellectual capital and really just the academic talent that comes from graduating students like yourself. Our diversity is another thing that I'm proud of. I can't stress enough, 68,000 people strong, 50 countries around the world. So you can imagine how we embrace diversity across every single country. Our footprint and our culture would not be who we are today without really not only the global presence, but the integration of our colleagues, our team. We truly do come together as one here in the Americas, but also all around the world. And it's such a privilege to be surrounded with the many different cultures that really embrace the talent that continue to allow us to lead with conviction in everything and recommendations that we bring to clients each and every single day. So with that said, I'd love to now get started on, again, kind of not only my background, as I mentioned, it'd be 25 years in December, But I'm really proud that not only to have acknowledgement from the industry, but more importantly, to have been recognized for some of the commitment. It's really been about giving back. It's really been about just the moral compass that we have, that I've ingrained through the years and everything that I do, and really just leading with conviction, just based on what we feel is always the right thing and putting the client's best interest first. And really, it's doing what you love every day and just really being there for clients, waking up with such enthusiasm, and embracing what you do and love, that has really led me through my career and enabled me to just continue to progress. So it's truly a privilege to be joining you this afternoon. And hopefully, again, you'll kind of feel the enthusiasm that I bring as we go through this presentation together. So, one of the things that we are starting to ask, and really just as we're on this cusp of the bull market, US inflation, as you can see, has climbed 6%. We are probably at the highest level that we've seen in inflation since the 70s, and then again in 1992. So it's been quite some time that we've really been experiencing the energy prices, but not only with energy, but with food prices, with real estate, with furniture, everything across the board. And some of that could certainly be blamed on the supply chain hiccups that we've been experiencing through the pandemic as a result of the shutdowns of the different economies, the backlog of the chain supply. And not only that, when the supplies do reach the ports, even in our own U.S. Borders, we still have issues with transporting those goods with the shortage of workers. So what this has really led has been not only inflationary pressure, but wage growth inflation as well. The irony is that the pandemic, while we had so many programs, fiscal programs, both to small businesses as well as individuals to help them through the pandemic before getting to work, the irony is that a lot of employees did not return to work. And that employee group really stems from not necessarily retirement age, but from age 52 to age 60, just decided to drop out of the workplace altogether. So we're hoping to see some of that coming back. We started to see a little bit of the supply issues also, especially with areas of services like hospitality, restaurants, and any type of entertainment, mainly related to the discretionary income. So while, this pandemic has allowed investors to save more and have more discretionary income as a result of staying home and maybe not being able to travel or have the flexibility to, spend the money as they normally would on entertainment. The irony is that, they've been demanding more and more things surrounding other areas like automobiles or bigger homes or furnishings. And of course, that's developed some of the inflation in some of those areas. We've seen, as I mentioned, an inflation in commodities, really starting with oil, which again, the irony is that when we looked at the sector of energy back in 2020, if we had any exposure to any type of energy companies or MLPs for that matter, the average return was about negative 52% for 2020. And then, of course, fast forward to the first 6 months of this year, and energy, of course, is the leading sector with returns upward north of 50% again. So really just breaking even it for those investors that got in at the wrong time. But nonetheless, we've seen that inflation continue not only with energy, but other commodities that have really led to, again, this inflation. We think, however, just based on the Federal Reserve's stance and dovish stance, now that remains to be seen. And I didn't follow the current events today. I believe President Biden is kind of on the cusp of determining if Jerome Powell will be elected again for another term as the federal chair, or if it'll be Leard Brainerd, who is another strong contender. perhaps taking over for Jerome Powell. At this particular point in time, the Federal Reserve remains patient. They keep calling the inflation the ugly T word, which is transitory. There are some economists, and for the first time in history, and I love it because you have really bright academics on both sides of the table, some that say that inflation is going to be persistent, especially as it relates to wages. In trying to, again, attract and retain some of the top talent, because companies have really been struggling, not only with hourly workers, but also with some of the professional services. And then there's the other side of the coin that says that, this is really truly transitory. And when supply chains start to thaw out and get some sense of normalcy in the middle of 2022 or towards this time next year, things will start to flush out. So interesting, to see both sides. A lot of great arguments, a lot of great points. And so again, there's no time like the present to be reading within the financial journals as you continue to witness firsthand what is evolving in this particular climate. The next question will be, who will be the winners from net carbon zero, or net zero carbon rather? So this is, another interesting point of view. As we saw the last 2 weeks, the CPO 26 summit ended on Saturday, and the consensus was to reduce the fossil fuel emissions. China and India, again, are also coming to the table, albeit, their timelines are much, much longer in terms of becoming carbon neutral. But the summit did resolve the rules to govern the trading of global carbon credits, ending 6 years of deadlock. There was also agreement on emissions reporting and guidelines that will increase the scrutiny of climate pledges. Now, you've probably been reading about this as I have, especially in the financial journals. And again, Barron's, who, as you know, I'm a big advocate of really staying on top of, as well as the Wall Street Journal. One article in particular in the journal Weekender actually had something really interesting as it relates to climate. They mentioned that Moody's estimates that the economic benefits from the transition to a climate resilient zero carbon economy could amount to nearly 25% cumulative gain in GDP over the next 2 decades, as opposed to avoiding or failing to act at all. So I think that again really sets the tone and the stage, as I mentioned, for the globalization of the integrated economies and all the important events that are happening. So, the moral is here that if we can avoid some of the rhetoric, net, I think there's a lot of positive things that are evolving out of Washington. The infrastructure bill being another wonderful catalyst and upside potential, not only to strong employment, but if you think about the infrastructure bill and the $1.2 trillion to the much needed just advancement of airports, of ports for goods and services being transferred in, to bridges and roads and all the areas that not only will put a strong employment force and help the GDP of economy, but also very much needed, both as it relates to our environment and safety and protection of our citizens. So all in all, a lot of agenda items that the administration is taking on. Kudos to them. But again, I think as we move forward in seeing really just how the countries of the world start to participate, we'll continue to see these wonderful advancements and how that really leads to the trajectory of the growth that companies will see across the board. I'll speak to you about some examples on that digitalization in a moment. But for now, let's go on to the next question. And the next question, as you can see here, is when we're looking at the dollar? And can the dollar continue to rise? Well, again, this is another area of contention where, as it relates to the Federal Reserve, there are those that feel that the Fed will not raise rates. Of course, their message on monetary policy was that they were going to suspend any further purchase. But again, that doesn't necessarily mean that they were ready to act in terms of increasing interest rates. That may change sooner rather than later, again, with this inflection of inflation really taking precedent, and then again, who gets elected to be the next chair. But for now, as we continue to see the US dollar, we saw its index rise to a 16-month high. These gains year to date on the US dollar has been about 5.8%. Of course, as I mentioned, that's aided by the inflation data for October, which showed prices, rising at the fastest pace in 3 decades. And this will continue to be the Achilles heel for the Fed, whereby they may be compelled to raise rates and tighten policies earlier than expected. So the US dollar does look overvalued on a fair value basis. But in the coming year, we expect this overvaluation to become even more pronounced as the Fed does move ahead compared to other central banks towards tightening. We've seen the ECB and Christine Lagarde, the head of the ECB, comment on the European economy about a month ago, and they're even more dovish than we are here in the US. And I think that the main reasons are justifiable in that while we start to seem to have somewhat of a recovery, there's still vulnerabilities as it relates to the pandemic, and certainly, areas of harm to all the economies if we should raise rates and suspend the ability to continue to grow the economy out of the pandemic. So the U.S. is less harmed than most major nations from the recent energy prices. Believe it or not, even at almost $5 a gallon. And for the first time, we became a net fuel exporter since the 1950s. So, a little bit of, I guess, an oxymoron, if you will, if for lack of a better word, whereby we are needing more energy and again, exploration as we're looking to the administration to negotiate with OPEC and Russia and some of the other world countries so we can get greater supply. But at the same time, the advancement of some of the other areas where credits are being applied towards, for example, electric vehicles. And I'll talk to you a little bit more about that in a moment. But we think that energy prices will start to level off by mid next year. And the US dollar, of course, will remain probably the favorite. So by the end of 22, we think that the US euro will fall to 110 from where it is today, and against the yen about 114 as compared to 116 where it trades today. So again, strong US dollar is the continued view here for us at UBS. So have Chinese equities turned the corner? This is another favorite topic of mine. I could spend a whole lecture speaking of China, and I've never been more enthusiastic in learning about not only what's evolved with the Chinese economy, but what we've seen is really truly history, especially within the last week as Xi Jinping has met with the other Chinese leaders and positioning them and him to be the world leader going forward. I think the meeting between President Biden and Xi Jinping this week has also been very favorable. It's been a volatile year for Chinese equities. I think some of the, again, rhetoric aside, some of the great things that we see coming out of China is that the October retail sales have rebounded strongly, beating consensus. Again, there are outbreaks of the pandemic that continue, unfortunately, in many provinces and travel restrictions. And by the way, that will also be one of the catalysts in this supply chain hiccups as China strives to, be the main exporter for their goods and services. And in fact, the common goal of common prosperity across for all of its citizens is really where Xi Jinping has, or President Xi rather, has really been the thought leader. I think, candidly, some of the areas that they're trying to really develop has really been for the benefit of their country in as far as the respect of the capitalization. And what I mean by that is if you think about China and where their growth has been, they've been able to develop a middle class population of 800,000 people in less than 50 years. 800,000 people to be on the cusp of moving from an agricultural economy to now into the cities, and such a vast development in goods and services and technology. And in fact, when you think about the Chinese economy and how quickly their GDP has been growing in vast speeds, without the capitalization ability, in other words, in the ability to raise capital in the same way as we can here in the US, it's just a phenomenal story. So China, as you know, with real estate expansion and the leverage and growing, again, their cities very quickly, has caused a lot of leverage. China, unlike the US, investors need to borrow from banks. So they don't have that same ability to tap into the capital markets as we have here in the US. And that's what makes our markets so great. It's so resilient, and the liquidity that it allows. And of course, that just continues to invite the growth of investors coming into our economy and the thriving of the business. China, again, is trying to move in that direction, which is why, again, they are starting to impose more restrictions on some of their IPOs. We've seen the fate of what happened to Didi over the summer. They are trying to move a lot of their companies towards trading on their own exchanges, Hong Kong, the Shenzhen, and the Shanghai exchange. And I think, within the next 10 years, again, with this evolution of now being able to have access to the capital markets being their objective, will allow China to continue to grow. And as we've seen, even surpass the US in terms of GDP expansion. So where do we stand on China? We believe that the worst is likely over for Chinese equities. We had a hold in a neutral stance, but the direction, again, will continue to depend on the further growth and how quickly the government is supportive of their policies that are rolled out. But we expect the MCI China to deliver mid-single digit returns for the rest of 2021, and anywhere between 6 and 9% growth to the markets, the equity markets, that is, within the next 6 months. So again, these are kind of the view that we see as it relates to China. And I'd love to expand on that at some point in time through a separate lecture in and of itself. The next question, why should the Eurozone equities outperform now? So when we look to the Eurozone, I started to say that, the ECB has been even more accommodative and will continue to be even more accommodative than our Fed here in the US. We've seen the stocks, Europe 600, reach a record high just this past week, and its index continues to close higher. It actually closed higher 13 days out of the past 15 trading sessions within the last 2.5 weeks alone, and is up about 6% in the last month. So did you know that after years of relative underperformance, the positioning continues again to be a risk-on rotation towards the Eurozone? And in fact, the Eurozone is likely to see solid GDP growth next year, anywhere between 4.8% to 5% for 2021. And then, of course, around that same growth going into 2022. Fiscal spending should remain supportive for the EU recovery. And the ECB, as I keep mentioning, remains accommodative much longer than other central world banks. With a cyclical sector composition that the European markets and industries are really known for, unlike the US and China that's really gravitated towards technology, the market is really well placed to benefit from green investment and CapEx. And really, with this resolution to solve the supply chain issues, we see the inventory being restocked. And again, forecasting 60% earnings growth this year, followed by another 8% earnings growth for 2022 for Europe. So the valuations still look appealing, even though we've seen that 6% climb, as I mentioned, within the last month. And Europe is certainly another area that we continue to think that there'll be winners from our global growth story. The next question becomes, how do I add to my portfolio? Well, again, as I started to say, there is no time like the present. I have never been so excited to see the development that we've been experiencing with small cap companies, with mid-sized companies. I know that we've seen a lot of the growth in technology coming from the large mega cap sector, the FANGs in particular, the FANGs being Facebook, Amazon, Alphabet, Google, Apple, Netflix, Microsoft. But we think that there are other areas of growth, especially within small cap and mid-sized companies that are also on the cusp of this beautiful revolution towards cybersecurity, towards health tech, towards e-commerce, towards the digitalization. Companies like Square that we probably, most of us never even heard of, up until a couple of years ago, are now becoming the latest digital technology evolution that will continue to thrive going forward. We see companies, even like Visa, being on the cusp of just working with the different financial institution to trade, for example, e-commerce in either cryptocurrencies or the fintech of working alongside with companies like PayPal. So, we're starting to see some of the older financial institutions also coming to the forefront with that growth in fintech that we see. And we think the digitalization of the economy will not only create more efficiencies, but really the younger generation, the Gen Zs and the millennials, have already gravitated to. And if you think about it, when was the last time you went into a bank branch to take out a deposit? I'm sure just as many of us have, now with the transfer of funds, even with some of the institutions like Chase having Zelle, or even UBS with a lot of the digitalization that we have, creating the ability to be able to transfer funds within the blink of an eye, or just a click of a switch, if you will. So all wonderful things that we see. But some of the questions that do come up is, Rita, if we have inflation and interest rates are working their way to be higher, within fixed income, which is where some of the more conservative investors would place their money, U.S. Treasury, corporate securities, for example, how do we navigate across that? Because really the real yield on U.S. Treasuries has been negative across the curve, ranging from negative 0.18% at 5 years to negative 5 basis points at 30 years, just given the inflationary numbers that have come in. So, some of the areas, again, that we think as a fixed income investor, again, this is kind of the new normal in the new economy. Equities is poised to really continue, especially as I mentioned, across some of these industries participating in this technology evolution. But also, too, in fixed income, there are areas. So, for example, U.S. loans offer an attractive yield of 4.3%, for example, when measured against the leveraged loan total return index. And there are even private institutions that have direct lending. And one of the indices there actually had generated 7.3%. For investors. So, this includes private credit, direct real estate, financial credit, and then, of course, as I mentioned, the senior loans. So, again, while we're not bullish in investing in Treasury or any corporates at this particular point in time because of the yields coming in and not really offering that opportunity of upside, there are other areas within fixed income that still offer yield opportunity. So how can I invest in these long-term themes? The moral here is really just understanding what is happening. I think the fiscal policies, the monetary policies, everything that's evolving right now really are building on these long-term themes. For example, President Biden will be visiting Detroit next week, and really, or actually, I believe this week, and he'll be rallying congressional support to have a $9.6 billion package of zero emission vehicle production tax incentives. President Biden has proposed electric vehicle tax credit of up to $12,500 per car, including union-specific credits of $4,500, of which has, again, drawn some criticism. But we think, again, as it relates to the global share of electrical vehicles, that trend is here to stay. We've seen the growth of Tesla. We've seen the IPO Rivian really taking off. We've seen already a lot of the Chinese companies also participating in electrified vehicles. And really, when we talk about electrified vehicles, we really think that 60 to 70% of vehicles by 2030 will be electrified vehicles. The automation, and we're already seeing this with companies like Amazon, driverless trucks. We talked about, some of the headwinds with employment, the shortages of employees, especially on the transportation side. Truck drivers has been an industry that's really affected the supply chain and some of the inflation that we've seen. So the automation and really the evolution now going into some of these areas of globalization for electrified vehicles, I think will be one of the game changers within the next decade. The size of the global cybersecurity market also, again, just as a result of employees working from home, and more employees are starting to demand that, in fact. We see that a lot of clients, for example, as you know, I consult to a lot of corporate clients, so HR and Treasury teams alike. But on the HR side, again, some of the challenges have been really trying to keep employment or recruiting top talent in employment. And one of the things that they are asking for is kind of 2 days off and 3 days on, sort of speak. So we don't know if this will become the new trend, but what we do know is more and more people do work from home. This has really lent to the cybersecurity market really growing exponentially. And in fact, just last year in 2020, we saw the globalization of money globally on cybersecurity spent at about $145 billion just last year alone. And we feel that it'll be growing about 8% annually. So as we continue to see the digitalization transformation of all these sectors, ranging from transport to manufacturing, financial services continue. Again, the smart mobility, the automation of all those companies benefiting from this growth, from the digital asset universe and in cybersecurity, those are some of the longer term themes of companies that we see being game changers within the next decade. So when we talk about again the equity rally continuing, some feel that the market is overbought. The risk return trade off is not justifiable. And again, if we look beyond all the rhetoric of what is going on, you still have to kind of see through kind of the clouds. And what I mean by that is there are companies, and the key is to look for those companies that are embracing everything that I've been talking about. Another company, again, within everybody knows Chevron, of course. And even Chevron, for example, had embraced, of course, their 3D printing for a lot of their different platforms, as they call them. But what Chevron had done in the past was, of course, they had suppliers, and their suppliers for all their infrastructure products or their plating or their again all the different things that they count on for energy exploration had become again uh, kind of hostage to the supply chain issues, as I discussed earlier. So what Chevron did was they contracted with a 3D printer company to actually have them build this particular part that they needed for their energy exploration. I believe it was an investment that they had said that was north of $54 billion in the country, in Australia. And as a result, the company not only was able to build this part for them in Australia, making the channel much more efficient for them to have the part, but Chevron decided to buy the intellectual program and just start making these parts themselves. So again, where I'm trying to go here is if you look beyond, again, just the areas of not only just technology company and what we've seen with chip shortages, but companies moving towards these footprints of 3D printing and the digitalization and the cybersecurity and the cloud computing and again the e-commerce, everything that stems with all of this technology advancement, those companies that are embracing that will continue to be the leaders going forward. And so this is why we've seen just the S&P not only at an all-time high above 4,700 on November 8th, but we'll continue to see new record highs, we think, going forward. Since the inception of the S&P in 1928, it's taken a median of 9.9 years to double. So if you think about, the move from 2000 to 4000 only taking 6.6 years, and this is kind of pre now technology and everything that I'm describing this afternoon, gosh, there's no telling to where the market really can go from here in doubling in even a shorter amount of time. One of the things that I also read that I thought was an interesting statistic is artificial intelligence. And total sales in the US robotics for the first 9 months of the year reached 1.48 billion. And robots are transporting packages as we speak at Amazon hubs all around the country. So this artificial intelligence, robotics, all of this is happening as we speak. And so that has been creating the productivity again for the efficiency in these companies in continuing to grow their earnings going forward. So we think that global earnings will rise about 43% in 2001 and 9% next year. We think cyclical sectors will outperform, including energy and financials. And in our global equity strategy, we feel that the Eurozone and Japanese equities are the most preferred areas. So again, with current issues still appearing to be more temporary than structural, we believe the equity markets will continue to move higher, and we will find winners from the global growth of everything that I discussed today, and really just this whole integration and being able to capture that in the global world markets. The last question, I believe, is the last question. No, two more. I'm running out of time here, so I better speed it up a little bit. But how can I capture opportunities in healthcare? Again, health tech, another area that we've seen such a huge transformation, not only, of course, with the vaccine, but even what we've seen in the news in the latest 2 weeks. Healthcare, conglomerate Johnson and Johnson announced that it planned to spin off its consumer products business from its pharmaceutical and medical device operations, really creating two publicly traded companies. So again, when we see health tech and where it aims to make healthcare more efficient, it's likely to remain the focus as we continue to have an aging global population. The increases in demand within the healthcare sector will continue, and we think the gene therapies that offer the long-term potential allow us to estimate, treatments to reach the market that could achieve combined sales exceeding over 20 billion going forward. Pharmaceuticals are still the most defensive industry within the sector. MedTech stocks are more geared towards the recovery. And global pharma stocks are trading at a 16% discount to the broader equity market on a forward 12-month earning basis. So transformational themes, we recommend taking exposure via diversified portfolio of companies, given the idiosyncratic risks of drug development. And as I mentioned, companies like AstraZeneca, Pfizer, Moderna, that continue to not only be involved with the virus development, but also the generic therapies that have been approved and will continue to be approved in the US by the Food and Drug Administration going forward. One other notable statistic, only because I gave a Social Security webinar yesterday on Social Security, the U.S. Centers for Medicare and Medicaid Services estimates that healthcare expenditures will reach $4.2 trillion in 2021, around 18% of our GDP, and about $5 trillion by 2025. Do you still have any doubts that healthcare won't be a preferred sector going forward? All right. Last but not least, as I mentioned, not a day goes by where we don't see some information and current events on crypto, or the famous B word, Bitcoin. Bitcoin's total market share within the broader corporate crypto market, you see, has really evolved. But again, as we continue to see the fears of crypto regulation, we see how it can really stoke some of the price volatility that we see and inhibit the adoption going forward. And in fact, this week, the US SEC on November 12th rejected a proposal to change the listing rules to allow for the trading of VanEck Bitcoin Exchange Traded Fund, saying that the fund had not done enough to show that it would prevent fraudulent and manipulative acts and practices. The SEC has previously approved future-based Bitcoin ETFs. There are ways, of course, as we continue to see the financial disruption in some of the areas like payments, lending, private placements, and the trade finance through digital platforms, Coinbase, again, being one of those enablers. So while we don't specifically like crypto coins in particular, we do view the direct exposure in crypto coins or tokens as an attractive alternative, only, however, for highly tolerant and speculative investors. We also focus on DLT and enablers and service providers. We like select chip makers and software companies and data center players. And we like the fact that we can see that from a financial services standpoint, the digitalization and the technology to supply chain management, looking for companies within those areas is where we tend to favor the crypto point of view. So crypto coins are highly correlated to each other, making diversification challenging, which is another reason why we don't necessarily like individual crypto coins. They're also very volatile, and their track record either as either a portfolio diversifier or an inflation hedge, which that's still a head scratcher for me, is mixed at best. So our view on crypto coins and tokens is highly speculative. We think that investors should not build strategic exposure to them within their financial portfolios, but instead consider DLT enablers, platform operators, and companies servicing the crypto ecosystem. And then, of course, for more information on all of that, you can email me, and we've got a lot of great white papers to share with you. So those were my 10 questions today. The current events, the most, I wanted to bring kind of the most current of what we're seeing, not only at UBS, but really what's happening in the world today. And really just allowing me to share that enthusiasm with all of you this afternoon. So, as you can see, UBS, even in the fourth quarter, our market outlook, we still remain bullish. Our 2022 estimates include a 4 to 5% drag from higher corporate taxes. But even so, we expect the S&P to be around 5,000 in December of 2022. So we use a forward PE ratio of just a little bit over 20 times to derive our year-end 2021 target. And again, I think that this really says it all in terms of our view on the equity markets and our forecast, both here in the US and globally. So with that, I'd like to just, I have a couple of questions that I've taken from Investors Business Daily, another media that I pursue, a forum. I love their top 10 secrets to success. And, every week they list them, and every week they have a wonderful success story from an entrepreneur that has grown a company, and they interview all types of CEOs across the board. So another media forum that I also recommend you participating in reading. But again, you can see here how you think is everything. Decide upon your true dreams and goals. Take action. Never stop learning. Be persistent and work hard. Learn to analyze details. Focus your time and energy. Don't be afraid to innovate. Be different. Deal and communicate with people effectively. Be honest, dependable. Take responsibility. Otherwise, numbers 1 through 9 won't matter. So thank you, class, for allowing me to spend this afternoon with you. I'd love to entertain any questions that you have at this time. And hopefully, again, you found this lecture, but more so just an interactive conversation, as I'd love to refer to it, as both intellectual, entertaining, as well as providing you some insight.
Thank you, Rita. Excellent insight, and we thoroughly felt that enthusiasm. So thank you very much for sharing all this information with us. You do have one question that I wanted to share. Our participants are thanking you for the presentation, and the question is: do you think the attempts to regulate the crypto market helps or worsens its volatility?
Well, I'm not an expert in the crypto, but I will say that the regulations will probably, in the short term, add to the volatility. We certainly, every time there's negative media, when China came out, for example, and I believe that they had, for lack of a better word, outlawed the mining of crypto. So a lot of the mining companies had moved out of China, and they started going to countries that were more accepting of mining, keeping in mind, kind of the mining process is against the environmental, again, as it relates to the energy grid. And really, we didn't even talk about the electrical grid and the energy grid that have been challenges in China in shutting down factories and plants, which again have added to the supply chain issues. So it's almost like this kind of evolving, dog chasing the tail, which there's always some consequence, whether it's unintended or not. I think remains the question. But you know, I kind of have a tendency to think that crypto is here to stay. I do hope to see more regulations around it. I think that, once we get a little bit of a better footing from acceptance from the larger financial institutions to give it a little bit more credibility, it may very well become another medium of trade. There was talk about 10 years ago with crypto that we would probably be going back to some type of barter economy by 2040 and eliminating currencies altogether, or at least giving the ability of citizens to be able to trade in currencies across, through each other, without necessarily going through financial institutions. So I don't know, Helen, with any certain uh, you know recommendation or kind of educated guess in terms of where crypto will go or end up. But certainly the anytime there's you know attention given to it from most notably credible sources, it seems to have a lot of volatility attached to it.
Thank you. Thank you for clearing that up. There is one more question. What do you think about solar energy's future? Because there are a lot of variables in the picture, and Germany's experiment to go full solar seemed to have failed.
Yeah, I think the Biden administration had there was one company, Solargram or Solar. I can't remember exactly, but I know that that kind of was a failed project. But you know, candidly, I think that when you look at we've got wonderful ESG folks over at UBS that would answer this question so much more eloquently than I would. But at least from what I see, solar energy does make sense in some states. California would be a great example. Florida would be another great example. Solar energy doesn't always make sense in some other states, like, for example, Illinois would be a great, kind of standpoint in terms of, creating subsidies for us to invest in solar energy, when we really, just based on our climate, don't participate that fully year round as some of the other states do. Having said that, I'd love to see more technology dedicated towards solar energy. And again, I think with the meeting that has taken place with the Paris Treaty, a lot of countries of the world, especially here, not only has the government stepped up, but I think even companies, like I said, Amazon is already working towards, robotics in some of their fulfillment centers. We've seen what Elon Musk has done to set this whole trajectory of these electric vehicles that, for years and years and years, our industry automakers were a little bit more reluctant to pursue with the type of vigor that it really needed. And I think the catalyst was that Elon kind of pushed those automobile makers that have always been the great economic drivers of our automobile industry to start investing money. And we're seeing that from Ford, we're seeing that from GM. And so I think the same thing will apply with solar. I think there'll be more and more companies that work towards solar energy, and then it'll just be a matter of time where we see more corporate spending and government subsidies to allow it to become more efficient. Because from what I understand, it's incredibly expensive today. So that's as far as I can comment. Other than that, I'm sorry.
Okay. Well, thank you, Rita. I know that we're right at time. We did have
Yes.
one last question, and then let me know if you mentioned that students can follow up with you if you want us to post your email address here, or if you want them to reach out to you via LinkedIn. Please let us know that. But the last question is, what opportunities do financial analysts have at UBS?
Well, again, I think that university program is a great way to go. There's a link on there for applying, and I encourage all of you to send your resumes. And I, I'm hoping by this presentation or giving this presentation, it allows all of you to see that, don't just think of financial institutions as your go-to. I'm hoping that this really opened up the horizon for you to recognize all the different areas of and industries and companies here in the US and globally that you could participate in, whether it's energy, whether it's biotech, whether it's, again, finance. Open up, the horizon. Don't, kind of put that vision that you have to join a financial company, because we're starting to see also a great turnaround even with the digitalization. Robinhood is a great example of that. So keep an open mind. And again, for any of you that want to reach out to me, LinkedIn is probably the best. I do post a lot of great white papers each month, sometimes as frequently as weekly. And of course, if you reach out to me on any of the supplemental information as it relates to ESG or anything that I've talked about, I'm happy to send that to give you really the meat of the underlying answers to the wonderful questions that were asked here this afternoon.
Fantastic. Thank you so much, Rita. With that, I think we will close out. Shazad Hussein has posted the careers, university students, opportunities, the grad talent program. So students have that link in the chat and they could directly link to that for those opportunities, as well as connect with you, Rita Fiumara, on LinkedIn, which would be fantastic. Thank you so much for always being a partner and a friend to Stewart School and to our students, and to continuing to provide great information and opportunities for the future. We truly appreciate it.
Thank you, Helen. I wish all of you much continued success.
Thank you. Thanks, everyone. Please do not forget to fill out your feedback form. And with that, everyone have a great afternoon. Thank you.
Bye bye.
Bye.